What if everything you've been told about property investing is a lie? Anastasia didn't wait and save hard to get started in property investing. She found a joint venture partner to fund 100% of her property deal. A project that created almost £200,000 in equity and a monthly cash flow of £2,500. And what's more, this isn't some difficult to manage HMO or hands-on Airbnb let. This is a 10-year lease with a social housing provider. So, interested in learning more? Watch the video in full. What if you could buy property using none of your own money, working with joint venture partners to create no money left in property deals, low management, low maintenance, and high cash flow property portfolio? Sounds too good to be true? My guest today, Anastasia, is here to tell us exactly how she has done this and to share in depth a real life deal, a real case study that we can all learn from. So, Anastasia, welcome to the call.
Thank you. I'm glad to be here.
It was a pleasure to have you. So you and I did an extended recording a week or two ago for our YPN Plus members, where we went deep dive into your strategy, this case study, other deals, and it just went so well. And I felt that you had so much to share that we wanted to drag you onto the YouTube channel, drag you onto the podcast to share your knowledge and experience to inspire and educate other aspiring property investors and even experienced property investors who may be stuck, just getting started or getting restarted in property. So I've got you back on.
Yeah, I'm really happy to share.
Okay, so first of all, before you were doing these kind of deals for yourself, you got really good at doing them for other people. Can you just tell us a little bit about that?
Yeah, that's right. So my journey in properties started really off with me buying an HMO on social housing for myself. It was a steep learning curve to start with. It was my first deal. I learned the tricks of the trade, I guess, with the first deal. And then I came across a property developer who was very short on time. And he said, well, Anastasia, how about we team up and then you do a deal sort of for me on my behalf? I didn't even know at the time what sourcing was, but that's the whole concept of sourcing. So you do something, you do a property deal for someone else. So I did the second deal for him and I thought, oh, I actually quite enjoy this. So then that's how I started my sourcing business, doing, finding the property, doing the refurbishment. All of my properties are HMOs and social housing contracts. So that was sort of the niche that I was helping my clients with, because to be fair, I didn't know anything else at that point. And it went sort of from one to the other, and I built up my sourcing business. But obviously with sourcing, what you have is you're building a portfolio for someone else. And I thought, okay, well, that now is a good time to add more properties onto my own portfolio.
Okay, great. So this is, when you're sourcing for other people, can be great for cash flow, putting money in the bank, terrible for passive income, compared to, owning a property portfolio. And you talked about social housing, because when we talk about high cash flowing deals, high cash flowing properties, quite often we're talking about HMOs or service accommodation, and both of those things, unless they're highly systemized, can be extremely labor intensive. You're in danger of creating another job for yourself. You've done this in a different way, by working with, by going down the social housing route. So we're going to find out a little bit more about that. So how does that work? Who are you renting to? What are they doing with the property? Who's living in your property? And how on earth did you find out about these people and get involved in this particular niche in property?
Yeah, absolutely. So for me, one of the key components when investing in property is that it had to be passive. I could not create another job because I have a job in IT. So I couldn't, so that I had to be really careful about that. So I explored all different avenues and I came across social housing. It was really a question on how to is to find different providers. So I started with the council, I went to different events, I started talking to people. And I think that is one of the USPs, what makes me, I guess, different to other to other sourcing agents, is essentially I build a network of social housing providers, whether they're local or whether they're national, to then exit the properties too. So at the minute, I'm working with 5 different social housing providers, and the tenants are all different. So their specifications and requirements are also different. So I am working with one of the providers who looks after, they call it a resettlement scheme. So people that come from different countries that are struggling in this country and need help to get onto sort of the property ladder. Then I also work with ex-offenders as well, who've just come out of prison, have nowhere to live, with children and disabled adults as well. So
I can see why this would be really appealing to people who want to use your services as a sourcer, because quite often what happens is someone sources a deal, and it can be a great deal or not, depending. And there's the keys, and now goodbye. The management is kind of down to you. You're either going to enlist an agent to manage it. If it's an HMO, good luck with that sometimes. Or you're going to be self-managing. But you're kind of left with that. You're slightly different because you pair up, a social housing provider with the property and the landlord, and it then becomes a lot more passive income in terms of long-term ownership. So I can see why this would appeal to your clients and with your sourcing hat on, and I can definitely see why you as an investor would want to explore this niche, and I guess dig pretty deep to make those connections with the relevant agencies, the social housing providers, the local housing authorities, those kind of people, because that doesn't happen overnight. I'm guessing that took some work to build up that network.
Yes, absolutely. It takes time before it's essentially establishing relationships with these organizations. When you do your first deal together, they don't know whether they can trust you, so the leases aren't very good, but then you gain more and more negotiation power as you build more relationships with them and as you hand over more and more properties. So you could say very much more strategies a little bit backwards rather than doing the deal first, and then thinking about what's going to be the exit strategy. I first line up the lease for a particular area, for a particular property, for a particular investor, and then I go house hunting. So it's a little bit backwards, but it does mean it takes a lot of the ambiguity out of the strategy.
Okay, and the other thing that can be ambiguous or open to, I guess, interpretation and can vary wildly from what we're expecting is the valuation on a property as well. Valuations can be very subjective. Sometimes we can put a valuation in and it can come back, exactly as we anticipated, or sometimes higher. Quite often, it can come back lower. And you've also worked really hard to kind of remove the uncertainty on the valuation process as well. So we're going to talk about that when we talk about this particular deal and how you kind of lock in, the end values before you even buy a property, before you turn the key in it, before any of your team start work on it. So it's really interesting you bring all those elements together to kind of remove the uncertainty, remove the hassle factors in terms of property ownership. And hey, let's be honest, there's plenty of those quite often. So tell me about this particular house. So this is a property in Kettering. So yeah, what was this? How did you find it? Describe the building to us.
Yes. So this was an off-market deal. I've got quite a few properties actually in Kettering. So the estate agent phoned me up and said, Anastasia, I've got this great property. Do you want to come and have a look? They sent across the floor plans. And I went to have a look at it before it went back on the market because the sale went through. I instantly knew there's a lot I can do with it because it was just very spacious. I took my build team or my contractor with me, as well as the architect, just to double check what we can do with the loft space, what we could do with the extensions. We made an offer on the property, which at the time was a three bedroom residential terraced house. and we knew we could, we could stretch it to 6-bed if we're putting a loft conversion in. Obviously, with a loft conversion, it's quite an expensive investment into the property. So to make it work, I knew I had to go down what we call an assisted living model. So it kind of falls under the social housing umbrella, but it is still slightly different because it is then considered you essentially making the residential home into a care home. So that's essentially, that was the plan before we made the offer. I run the numbers worked. We made the offer, and because it was a cash sale, we completed within 8 weeks. We got the keys within 8 weeks on this property.
Okay, so this is a standard 3-bed terraced property, of which there was a million or more out there like that probably, but with the ability to turn it into a 6-bed if you can get the loft conversion sorted as well. You paid £150,000 for £150,000 cash. Now, I'm going to make the assumption now. I'm not making the assumption. I know this is not your £150,000 cash, was it?
Correct. Yes, correct. So this was my JV deal. So I set up a joint venture with a previous sourcing client of mine, because the relationship was already established, the trust was already there, and I presented this as a complete hands-off partnership, because when you do a joint venture, you both become directors. So I'm able to go through the legal process, go through the application. So essentially, my name is on the property, so I can manage it end to end. We decided that we actually want to do this on a 5-year basis, at least buying one of such properties into the portfolio on a yearly basis, which seems very lucrative to both of us, because it's so we decided to set up the joint venture, and after that I went hunting for the actual house.
Okay, great. So you found the house, you've got a plan for it. So it's going to be an assisted living setup in there, which, as you say, is, from a planning perspective, I guess is the same as a care home. So it's going to be valued differently. We'll talk about that in a minute. So as a care home, who's living in the property? Who's being cared for in the property?
So these are your 16 to 18-year-olds that just need a little bit more support with, some of them are in college, some of them are working, but just need a little bit more support in terms of getting out there in the world. Maybe they've come from a challenging background in terms of family situation, or maybe there's some mental health issues. But essentially, it's there's going to be 5 young adults going to be living there, and one of the bedrooms is reserved for the supervisor, who can be there during the day, supporting them with all the questions that they might have.
Okay, brilliant. And this is a commercial contract, a commercial lease, fully preparing lease, I guess. So you hand the keys over for how long?
So in this case, initially we discussed 5 years, but now they actually want to extend it to 10. So it's becoming what we call a 5+5 contract. So there is a break clause in between, but the contract itself, or the lease itself, is for 10 years. So for those 10 years, you will have the care agency looking after the tenants, the vulnerable young adults. Then you have the housing association actually looking after the property. And then you also have the commissioner support. So this is your council, your local council support, that now sees that house not any longer as a residential house, but now we've converted it to a C3B class, what we call it, as a care home. And they've approved that application. So now it is a care home, which, as you said earlier, is valued completely different to your standard bricks and mortar.
Okay, so let's talk about how much money you spent on this thing. So you've bought it, or you've completed on it. You spent £150,000 buying it.
Yes.
What do you do then? What needs to be done? How much do you need to spend to transform it into this care home?
Yes. So the investment is quite considerable. It came to 130,000 that we had to invest to bring the property up to the standard that it needs to be to become a care home. Yes, so with the fees, all in all, we were looking at about 310 that we've spent in total on this particular project.
Okay, and what did that involve then? So you say to make it suitable for, for use as a care home. How would that differentiate from, just I guess a kind of more cosmetic refurbishment? What do you have to do sort of specifically for that market?
Yes. So there are stricter health and safety requirements. So we're thinking so for example, your escape windows, the width of your hallways. In this particular property, we had to put a double door in because there were one particular vulnerable adult with some mental instability that we had to put a double front door in, essentially. There are your standard fire eggs, which is your fire doors, your proper fire alarm. So it's all evolves around the health and safety, and also if you were to compare to a standard HMO, so standard HMO, I think your bedroom sizes are very different to what a care provider needs. So we're looking at least at 11.5 square meters that the bedroom needs to be. And most of them, so all of them are actually with an ensuite, and some of them are self-contained as well. So they are, again, dependent on the profile of the tenant. They might want a little bit more responsibility, so then they're moved into more of a self-contained room where they can also do some cooking. And all of that requires planning, and all of that requires money to bring that up to that standard.
And so you're not developing a property and handing the keys across and saying, hey, I hope this is what you need, oh, this is what you like. You're having that consultation, I guess, at quite an early stage to say, we'll develop, property that's fit for purpose for you. Give us the specification, tell us exactly what you need, and we'll go out and create this thing for you. Is that how it works?
Yeah, absolutely. As I was saying, it's the same approach that I have with my sourcing business. I first established a demand with the council and with the care agency. So that's number one. They'll basically say, we're really looking for self-contained units, or we're looking for HMO, so we're looking at whatever they're looking for in this particular area. So I already know what they're looking for, and then I go house hunting. When I actually have the property, I bring in the care agency in there very early on. Because they are the ones that know who the tenant is. They'll essentially will have the names. They'll know exactly what the needs are. So they will say things like, we don't want a carpet in this room. It needs to be LVT, and we want these colors in this room. They will give you an exact spec. And by that time, obviously you don't do that. You already have a lease with them agreed. Essentially.
And that was going to be my next question, actually, because what you don't want to do is to say, get this whole list of requirements, develop the property for them, and then they go, hey, you know what, we don't need that one anymore. We found another property. So you're locking that in before you even, I don't know if it's before you buy the property, I guess.
There is an element of trust. It kind of goes in parallel, but I'm not as early as, I'm only looking for the care agency. I know the care agency. We know the tenants. We're discussing with them. We know there is demand on the council side, because that is the biggest puzzle. The council needs to sign off, and they're usually fairly slow. But again, they have already indicated to us that there is demand, but still there is an approval process in place. So there is always this is not a strategy for the faint-hearted. So even though you're doing all the right steps, things can still go wrong. And that is why when I do take on, let's say, a new area, I do make sure that I have other social housing providers operating in that area. Should this, even when the care agency and the housing association want to make it work, the council might still say no. And with all the good intentions from everyone, this can still fall through. So it is a really risky strategy where we do try to eliminate as much as we can and have everything up front, but there is always an element of risk.
Sure. Okay. Hey, property is risky. We know that, and our job as investors is to try and mitigate those risks wherever possible. We can't eliminate them completely, but it's to mitigate them as best as we possibly can. So I really want to talk to you about your end valuation on this property, and then we're going to talk about cash flow, because £150,000 terraced house, okay, there is no way on earth that had you been, getting it valued on a bricks and mortar basis, even after the work you've done, it would value at what it valued at. So let's tell people what this property valued at. So I have the number in front of me, but it's best coming from you.
Yeah, so we're looking at £500,000.
Wow. So you spent in total £310,000, including buying it, £150,000 of that to buy it, and you've got an uplift of nearly £200,000 in value. There is no way that's coming from the bricks and mortar valuation. I don't know how that would happen. So tell us the difference. So you're using commercial valuations. Can you talk us a little bit about that?
Yeah. So, to start off, it is a commercial valuation because essentially it is now a business that has a guaranteed income for the next 10 years. You've got the approval, so from the care agency, from the housing association, and from the council. It is a very solid, a very solid plan, because let's say if the care agency, something happens to the care agency, we have the housing association and council, we just find another tenant for it or another care agency for it. So same happens with the housing association. So it's very solid. Over the next 10 years, this is what this business is going to essentially generate in terms of revenue. Now, because this is a care home, the commercial valuations for a care home are slightly different. Now, this is, again, something that you'll only know once you get into this. There are loads of different care agencies and there's loads of different housing associations, and all of them are at a very different sort of phase. They could have just registered as a business. So the care agencies and the housing associations I work with are very established businesses. So when this as a business plan comes in front of the valuer, so you've got a 10-year lease with a housing association that's been operating for 20 years, and the care agency that's really established across the country or across the region, whatever it is, it's a very solid business plan that the lenders, value very high.
So this is all about the strength of covenant, isn't it, on the lease? Like how reliable is your tenant going to be? What's their ability going to be like to continue to pay the rent for the next 10 years on the property? It's a little bit like having a kind of blue chip client. If you had a commercial property that's let to, I don't know, let's say Costa or McDonald's or somebody like that, real big brand names that we go for a long, long time, it's going to be worth loads more than if it's a hairdresser, an independent hairdresser or something like that. So, okay, so and what's the lending like in terms of this? Are you still looking at kind of comparable rates and loans to value when you're looking at refinancing?
Yeah, absolutely. It is a little bit higher than if this was a small HMO. So you're still looking at 75% LTV and 6.6 we got on this one in terms of the interests.
Okay. And is that on an interest-only basis or on a repayment basis, or how does that work?
This is interest-only for us, yes.
Okay. Interesting, because there's a perception, I think, quite often that commercial lending is only going to be done on a repayment basis, and there are a lot of myths around that. So it's great to hear from someone who's actually out there doing this. This is absolutely possible. So now there's two other really cool things about this deal that I really like. So when you refinance the property, quite often I ask, well, how much money was left in the deal? So after you bought it, done all the work on it, paid all that money, when you come to refinance, how much of your cash is left in it? And so it's an interesting answer on this one. So yeah, tell me how much cash was left in this deal?
So we didn't leave any money in this deal, and in fact, because of our valuation, we had almost £67,000 on top of our that we managed to pull out of this deal.
Okay, so £67,000 cash out of the deal, point of refinance. Again, really, really useful working capital to go back into the next deal or working towards a bigger project or whatever it might be. And then the final bit, tell us about the cash flow on this deal, because I said earlier on, when we talk about high cash flow deals, we're normally talking about kind of, relatively high maintenance HMOs, service accommodation, where you're turning over guests very, very often. Tell me how much money this property puts in the bank each month.
Yeah. So the other great things about this strategy is that there is no other fixed cost to it other than your mortgage. So we have managed to negotiate a rent of 4.3 thousand per calendar month for this property. And at 6.6, the mortgage is just over £2,000. Okay.
Okay. So a no money left in deal you did using none of your own money, working with a joint venture partner, which you'll continue to sort of grow a portfolio with, and makes over £2,000 a month profit with no void periods, no management, no additional costs, no unforeseen costs that come up through the ownership. This sounds like a dream deal, but I know that a huge amount of work went into this way before this deal was ever done, building those relationships, understanding the process. So if anybody was looking at doing the same thing, where do you think the potential pitfalls are? Where can this go wrong? And did you have any hiccups along the way as well?
Yeah, I think the biggest challenge is in working with the right providers for this, with the care agencies, established care agencies, with the housing associations, understanding the process of assisted living accommodation. I think that was for me going into this. Obviously, I did already have quite a good understanding and experience about social housing, but that was the biggest learning curve for sure. Anyone going and trying to do this strategy, that will be sort of the starting point, is just try to get your head around this whole industry, really.
Okay, and what a cool business, what a cool deal, and I can't believe you're doing outside the job as a full-time job as an IT professional as well, and other commitments as well. I know you have, don't you?
Yes, yeah. I work I've been in IT for over 12 years. So as a program manager, that's what I've been doing. And I also have 2 children, so that keep me very, very busy. So yeah, life is challenging, but that's how I like it.
Okay. Managing a job, kids, a property business as well, and these types of deals, I take my hats off to you. Fortune favors the bold, I guess. And, it's incredible to connect with you and hear about this deal and and others like it in our extended interview. So it's been an absolute pleasure talking to you today. If you're watching this video or listening to it on the podcast and you want to hear more about this, you can follow the links and become a YPN Plus member, watch the video in full, read the full article that we did with Anastasia. It's really, really cool. We've just scratched the surface today. Anastasia, absolute pleasure talking with you today. Thanks for joining me on the podcast.
Thank you for having me.